Welcome to the Pacesetter Pod, where we explore and reveal the perspectives, insights, and approaches to deliver great results and growth in your agribusiness through better execution. Here's your host, the Integration Pacesetter, Joe Mosier.
Welcome, Pacesetters of Agribusiness, to another episode of the Pacesetter Pod. I, as always, am your host, Joe Mosier. Thanks for joining us today. Hey, a real quick reminder before we jump into today's episode. If you haven't done so already, now is a great time, actually the perfect time, for you to subscribe to the podcast to ensure that you never miss any of the content or the conversations that we publish each week to help you deliver better results in your agribusiness through better strategy execution. Today, we're going to be talking with Rob Fox and Tanner Ehmke of CoBank's Knowledge Exchange. For those of you who may not be aware, CoBank's Knowledge Exchange is an industry-leading research and knowledge-sharing program, and their team of economists and analysts covers agriculture, rural infrastructure, and other related industries, all for the benefit of customers and business partners of CoBank. It's a great service to the agribusiness industry and to all of you listeners to this program. It's highly relevant, and so I'm excited to share this with you. Now, Rob is the director of the Knowledge Exchange, and Tanner is lead economist for grains and oilseeds. So both skilled, trained, credible economists with really good perspectives on a lot of issues facing the conditions that you all compete in every day. Tanner is actually a returning guest to the show, and we've had several others from the Knowledge Exchange team on over the past couple of years, and I'll make sure that we have links to those episodes in the show notes for you. Again, Knowledge Exchange and CoBank have been great partners to the Pacesetter Pod, and we really appreciate their willingness to continue to engage. You know, as we record this in late April 2024, we're in very tumultuous times. And I'm generally hesitant to talk about headline news on this show because I fear that it might be so episodic or so time sensitive that by the time we publish the episode, the news cycle has moved on and the content is not timely, nor is it even relevant to you. So that's why we haven't really talked in great detail about things like tariffs or Section 301 and levies on non-U.S. built, owned, or flagged vessels and what the impacts on our markets could be. We haven't talked really in detail about any of the other points of leverage that are being deployed in the current trade negotiation environment. And today we're not going to largely break with that streak other than to use maybe some of these current events as a way to help us evaluate what some of the longer-term threats, longer-term opportunities, the long-tail implications might be as an outcome of what we're in right now. So things like the current state and the likely prospects for free trade, both multilateral trade agreements as well as bilateral trade negotiations that we're undergoing right now. You know, we'll be looking at the current state of global grain supply and demand and how the trends around supply and demand are likely to shape the world of agriculture in 5 to 10 years ahead, and what you can think about as you plan your business around that. We're going to dig into BRICS. If you don't know what BRICS is, we'll define that in the show, but we'll dig into what is BRICS, how has it evolved, what is it trying to do, and really having a sober, credible assessment of what's the true threat level to a consortium of non-U.S. or Western countries that are looking to challenge the current distribution of power and influence in the world. We'll talk about de-dollarization and risks and a number of other topics. There's no simple answers to complex, nuanced issues like these, to de-dollarization, to trade negotiations, to global supply and demand, to all the turbulence we're facing. But I don't think that the lack of simple answers should preclude us from wading into those waters from time to time. And that's what the show's about, is digging into these kinds of ideas and trying to make sense of it and maybe find a couple of through lines, things that are relevant to you and your business that might help you plan better around opportunities that are going to present themselves, or perhaps avoid some non-obvious risks that suddenly occur to you in the course of a conversation. You know, Tanner and Rob gave very generously of their time and perspectives. I really enjoyed the conversation. I hope you enjoyed it as much as I did. And with that, let's thank Knowledge Exchange and CoBank one more time before we drop into my conversation with Rob Fox and Tanner Ehmke of CoBank's Knowledge Exchange. Hello, Tanner and Rob. Welcome to the Pacesetter Pod.
Good morning.
Thanks, Joe.
Thanks for having us, Joe.
Yeah, you bet. This is I've been looking forward to this conversation, and there's lots of different directions that we could go. And I know that you all have a lot of perspectives and observations around the macro environment in which agribusiness operators and producers are competing and operating these days. But let's start off. I'd love to hear your thoughts. I call this kind of the threat medley, all the different potential displacement or destabilizing different trends and actions and things that are happening right now. You may not see it that way, but when you look at the overall macro environment and headline news and things that are probably the most pressing threats or issues facing agriculture and agribusiness, what comes to mind? What's the 2 or 3 things that you're spending the most time thinking about?
Well, I guess I'll kick it off. Sure. Yeah. I tend to look more in the 10 to 20-year horizon rather than what's going on in the news today with tariffs and things like that. But, to me, and I've been looking at this for several years, is that our grain production keeps increasing at a healthy clip in the world, right? With former Soviet Union, Brazil, other South American countries, both acreage and yields keep rising quite aggressively, corn particularly. But there's a disconnect between the supply side and the consumption side in that world population is, for all intents and purposes, flat. People are still hung up on a thought process from 10 to 20, 30 years ago that, the world is growing population-wise out of control, and there's going to be 10 billion people before we know it. And really, if you look at demographic data over the past 5 years, really, or even going back, there's no way we're ever going to get 10 billion people. Almost every developed country in the world right now, and that includes China, we are flat, if not shrinking, in terms of population. So that leaves a handful of countries in Africa and Middle East, a few in Asia that are still growing. So the problem is, what are we going to do with all this grain that keeps coming online? And the fact that our global population is essentially flat, but it's also aging. And we know that older folks tend to consume less in general. So that's what I'm puzzling with. And I thought the answer was going to be biofuels, right? Because the world is short. We're long on grain, but we're short on energy across the whole energy spectrum. For example, electricity, everything is going to be electrified. Well, we don't have enough electricity to supply all that. So that's putting pressure on natural gas, oil, we're bringing nuclear back. To me, it doesn't look like it in the next year or two, but eventually we'll come to our senses and realize that biofuels are going to be the logical solution, or one of many solutions to the global shortage of energy. So that's kind of what I think is the most important underlying factor. Despite the mayhem we see in the headlines every day.
So in many ways, I know a lot of the time we talk about, access to overseas markets, for example, or tax incentives and clarity around regulatory frameworks that support or incent the building of biofuel refining and SAF and things of that nature. But what you're actually getting to, Rob, here is that we may actually be looking more at a supply side or an oversupply issue relative to actual demand. And that might be what is likely going to be bearish in the near term for ag markets.
Yeah, well, I mean, definitely near term, you can see in prices, and we're not going to build a big global biofuels industry. We already have one. We're not going to expand it greatly in the next couple of years, so it's going to take a while. Tanner, I'd like to hear your thoughts on, the next few years. Where's all this grain going, right? What are we going to do with it?
Well, we're going to have to reroute around China. Mexico is going to be a growing destination over time. Rob, you're writing about that right now. And then, like you mentioned, it's like Southeast Asia and some of these emerging economies. And there's opportunities out there, but the opportunities are not like what we saw with the growth of China. These are all smaller economies with smaller populations. So, place in specifically Southeast Asia in the near term, India further out, and then Africa at some point later on, where we've got growth opportunities in terms of caloric consumption, which basically is to say the value-added products, whether it's biofuels or meat, dairy, eggs, those kind of value-added products are where the growth is going to be, but it's going to be smaller. And then you've got the whole issue here of how much wealth growth are we going to see if we're going to see a slowdown of globalization. And I don't know if we're done writing the story here about the end of globalization. I think it's just changing. We have to export. We will continue to export. And right now we're, I think, in this phase in the near term, trying to understand what the future looks like when we got so many uncertain things here in the near term. But I still think longer term, we're going to have export opportunities. It's just going to be not the same. It's going to be different in the smaller markets. So the growth that we saw, like Rob was talking about earlier, it's not going to be the same going forward. It's going to be slimmer opportunities, more niche opportunities.
So kind of building on that, Tanner. So this idea of the story's not done, but a post-globalization era. Certainly free trade has fallen out of favor with a big part of the North American electorate. And it's held with skepticism in other parts of the world as well. Obviously, we're in a frothy period right now, and we'll see where everything actually lands in the months and years ahead. But free trade being the boogeyman, nothing is quite so simple. And I think there's been a lot of ink spilled around what free trade has enabled in agriculture, right? Access to growing markets, namely China, as you said, for soybeans to be processed there, overseas destination for corn to feed animals. Clearly, we've exported wheat for many years, even DDGs and sorghum and other sort of feedstocks. But have there been any specific to ag sectoral downsides to free trade that we now are maybe getting out from under? Because it seems like largely the press around free trade for ag is largely a positive story that has been a clear net benefit. But I'm wondering what might have been some of the downsides that we suddenly, as a byproduct of this period of time we're in, we have an opportunity to get out from under.
Robbie, you want to take this then?
Well, if we're thinking about heartland agriculture, your Corn Belt, Great Plains, I'm thinking hogs in Iowa and dairy cattle up in Minnesota and Wisconsin and so forth. It's tough to come up with any scenario where free trade has been a negative for that part of agriculture. You have to go probably to maybe produce, tomato producers, citrus producers, other produce, fresh fruit and vegetable, berries, right? All that stuff is, we don't have a great climate for it to begin with, and it's highly labor intensive. So the lower labor costs down in Mexico, primarily, also Peru and others in South America, that has impacted our fresh fruit and vegetable industry. But, for center of the country, America, free trade has been nothing but good. It's particularly, I'd say, on the animal protein and dairy side. We used to not export any dairy. Right now we export like 15% of our dairy components go across the border, right? And that what would we do with all that like non-fat dry milk? That we don't need it here. So it's adding tremendous value. And the same with with meat products, that are some of the offal and chicken paws and things like that. It'd go to rendering, right? But we're able to send it overseas and get a pretty decent margin on it. So it's tough to come up with any downside. Tanner, can you come up with anything?
I think you pointed out the stress point in ag anyway. It's on the produce side, produce, horticulture, all the imports from Peru, Chile, Mexico, that part of the world. It's done cheaper. They do it very well. They've got dry climates where it's kind of like Central California, the Central Valley, and their labor is cheap. So yeah, those imports are really hard to compete with here in the U.S. Otherwise, import-wise, I'd say it's always a test of your high-cost producers in any environment, but in a free trade environment, your least efficient producers are going to be stressed. So I'd say that there might have been, in any aspect of agriculture or any business really, in a free trade environment, your high-cost producers are going to exit.
Mm-hmm.
And so there's more an incentive there for your low-cost producers to expand. So I think that's been an ongoing story since always. That never goes away.
An ongoing story since always. So if we pan back, something I've been thinking about is, we've gone from a world, and this is not recent. This has been now over a couple of presidential cycles, but we've gone to a world where we very much were focused on multilateral trade agreements. NAFTA, of course, now USMCA, is one of the most notorious of those, but there was TPP, Trans-Pacific Partnership, I believe, or some derivative thereof. So we really emphasized these trading block arrangements and structures to facilitate the free trade that we're talking about here, where you would move production to the place that had natural competitive advantages to do it in the most highly efficient way. And we're now in an era where it's much more, or at least feels more from my seat, on a bilateral, direct one-to-one or much smaller consortium type agreements. One is that, do you see the same thing there? Are we going into more of a bilateral trade negotiation environment? And if that is true, what opportunities does that unlock, or maybe what limits does that put on how effective those trade agreements can be in support of U.S. agricultural production?
Well, I mean, it's definitely true. And it goes back even to the Obama administration, I think, is where you can find the seeds of this dissatisfaction with multilateral trade agreements and the WTO in particular, some rulings that didn't go our way. And all of a sudden, maybe free trade wasn't so great. If America can't dominate the whole process, then maybe we don't want to play the game anymore, right? So it's been a slow build, and definitely with the current administration, really feels it has better leverage if it tackles agreements one-on-one versus the idea is we have more leverage if we go after India, right, one-on-one versus take on a whole trade platform in the WTO or something of that nature. But the problem is then you wind up blowing up the existing trade system with different tariffs, different quotas, and different agreements with every different country, and ultimately millions of lines of tariff quotas that for every single product there is that you can think of, there's a tariff line, right? You got to figure that out. And you start dealing with this with multiple countries, and it takes years, right, to do this properly. So what's the upside? I'm a free trade guy. I've always been. I was in Geneva a couple times in the WTO negotiations as a support person with the Foreign Agricultural Service, and we were back in the Clinton and Bush second Bush administration, very involved and pro free trade at the time. And that's, I guess, a leopard doesn't change its spots. So I believe in free trade personally. And we're devolving into kind of a free for all with each country negotiating their own rules and so forth. So I don't know if that answers your question, Mark.
No, it does. Tanner, any thoughts on that? Just this idea of using leverage, which has been obviously a message that we've heard of in these trade negotiations, has been using what has been perceived to be unused leverage in the past, the strength and size and scope of the U.S. economy, and now applying that leverage in more direct one-to-one nation-state to nation-state negotiations versus these large consortiums. Any additional thoughts to, obviously there's the risks to Rob's point here of blowing up the existing programs, but what might be available to us by doing this?
Maybe there might be some opportunities. Might be some ways to address some certain trade limitations or trade restrictions that we've had in the past that have been unchallenged or other countries haven't moved on. For instance, it's really hard for the U.S. to export dairy into Canada, for instance. The EU has a lot of trade restrictions on grain with phytosanitary restrictions. Those are things that have always bugged the U.S., and it's fair game. Those are restrictions that need to be dealt with. But the analogy I've heard before is that, we're trying to cook a steak by burning down the house. That's not a good path because you burn the steak and you don't have a house. I think we're finding out the limitations here of taking this one-off approach because, as we've figured out here in the last couple of weeks, there is one voter that no politician is going to ignore, and that is the market. And the market is imposing some discipline, I think. So I think we're probably in the future, after this experiment for how long we're going to be in this phase of trying to undo globalism and trying to undo these, or trying to do these one-off trade agreements, we're going to go back to this idea that, maybe we do need to work together in order to preserve a solid trading environment. So I think it's concerning now, and there's a lot of questions, but the last couple of weeks, to me, say that the market is going to punish anybody who tries to undo it, and it's going to be really hard to undo this whole trade platform that we've built over this past several decades. So I think we're going to try it, and we're going to realize it's not going to work. We're going to have to go back to the multilateral format. Okay, how about we all sit down and we lower tariffs together, rather than us bringing a bully stick and forcing you to do things our way? That's not going to work. We alienate our trading partners, and you're going to get punished by the market when you do that.
I mean, you see people are realizing we don't have as much leverage as some people thought we had.
Yeah, there are limits. I agree.
We import, for any major economy in the world, we import the least amount. So meaning not in percentage terms of our GDP. We're not an import intensive country. Therefore,
writ large, Rob, or just within agriculture specific?
All total, right? All imports of, cars, chemicals, whatever, it's something like 14%. Don't quote me on that. I think I did some work. 14% of our economy consists of imports, which is much smaller than Europe and Japan, Korea, and so forth. So my point bringing that up is really the world can get along without us if need be, right? China can get along without us if that's the way we want to negotiate, right? So if you see, since the beginning of the year, the U.S. stock market's down about 10%, as of today. The Chinese stock market is up, I think, 8% or something, even with the come down. So, you see a 20% shift in equity markets to the negative side for the U.S. So that gives you a little bit of clarity as to where the leverage actually lies.
Yeah, and to timestamp this, we are recording here in the last week of April. So just for dear listener, if you're wondering what the heck is Rob talking about, because the U.S. is on a tear and China's tipped into recession, for example, that might be because we're recording this on April 24th. But and it's different than what Rob just summarized. Tyler, you make a really interesting point around known trade restrictions and sort of pain points. You mentioned the difficulty exporting dairy products to Canada as an example, that we maybe didn't have the mechanisms that we felt functioned properly to seek relief. And I wonder if in this shakeup that we have of the global trade complex, if there is this eventual return to multilateral consortium-based agreements, if there won't be a revisiting of how members of those consortiums and those trade pacts can raise and then seek relief and maybe have fewer barriers to having them be sort of, killed in the cradle. Because I know that is something with the WTO that has been long a complaint of many countries, not just the U.S., is that they have legitimate beefs, they have legitimate things that they would like to have scrutinized, reviewed, and shown in light of day, but the process by which that is authorized to come forward and get the attention it deserves is Byzantine and perhaps unclear, and it suffocates the process because it's lengthy and sort of almost by default will mute objection. And so maybe, I don't want to be Pollyannish here, but maybe that's one of the positive outcomes of this, is that we actually have situations whereby any trade partner can more efficiently raise these concerns and have them vetted in a public and thorough way.
Yeah, I think that you're bringing up a good point there. It takes a long time to challenge a country in the WTO. It takes 5 years for an investigation or something in a really well, by that point, it's ancient history. And so I understand the frustration and the desire to expedite justice. Justice must be swift. Nobody likes sitting around on their hands, right? Yeah. So I understand that. But again, do we really want to burn down the house to cook the steak? I think maybe slow walking things is the way to do things.
So, we don't go back to ancient history, but obviously globalization started immediately after World War II, right? And the U.S. was the dominant driver of the process of opening markets, particularly to benefit us, right? We had this massive industrial complex built up from World War II. War ends. What do we do with all this manufacturing capacity, right? We want to export. We want free trade. We want to move stuff out. So that's the genesis. But it took 50 years of dogged negotiations, right, to get us to where we are today. And there are certain industries within certain countries that have cultural, political significance that you are never going to open those markets, right? Yeah. I'll give you an example. Japanese rice. Japan is never going to sacrifice the rice production and rice farmers in Japan. It's never going to happen. So people have to be realistic when they point out these extreme examples. For example, Japanese rice or Canadian dairy, right? There's a history why these tariffs and protection exist. And we have our own industries like that too.
We do.
I'm not going to say, but we have them. So it's not realistic to think that we're going to open up all these markets just because we said so.
Poorly executed mergers and acquisitions destroy more value than they create. They can set your company back years. To defend your firm's position in the marketplace, you need access to the leading practices that unlock the greater potential of your people, processes, and systems. If you are undertaking a company transformation or pursuing an acquisition as a vehicle to grow, set up a call with Joe by visiting www.moshercg.com.
One of the reasons I was really excited to have you both on the show is, and Rob, that's very well said, is actually challenging some of the prevailing headline wisdom, let's say, in the media and the platitudes or the statements that are made that if we do this, this will happen. And or we need to open up the Japanese rice market. They have unfair trade barriers, for example. And if we do these things, we'll make that available. And I would say in many ways, that's almost like opportunity inflation, because it suggests a future that probably is not realistically available. But similarly, there's a lot of also threat inflation too. And so a couple of things that come up time and again when we talk about the shakeup to the global trade order and changing the U.S.'s relationship with their historical trading partners is, well, there's a couple of them I want to talk about, but one of them is, of course, BRICS, or now BRICS Plus. And for listeners maybe have heard about that but aren't familiar, BRICS is informal association of nations. BRICS stands for Brazil, Russia, India, China, South Africa. And now BRICS Plus has, over time, has evolved to pull in additional countries like Iran, I believe the UAE, or some other Gulf states. There's a variety of countries around the world that have come together to, in effect, form a block of nations that are interested in perhaps counterbalancing Western hegemony and having an alternative economic source of power or center of gravity. And one of the things that I've heard a lot about is, if we start to exit our trade agreements and we become antagonistic to the world, we are frankly giving oxygen to BRICS. And BRICS is the systemic risk to our economic superiority and position of strength and privilege in the world. When you guys look at BRICS or BRICS Plus, what would you say is the credible assessment of the potential for BRICS to do what it wants to do, and maybe talk about more eloquently than I did what it wants to do, but then almost, could that actually become a credible threat to the United States at scale? How much attention should we pay to something like BRICS?
Well, I think BRICS is a symptom of evolving global discontent with U.S. and European leadership on the world stage, and particularly, this, I'm not an expert, but, I think a lot of the sanctions that we've put on various countries and use of financial sanctions has made a lot of countries nervous that they could theoretically, even if they don't face sanctions today, they might one day, right? So they're looking for a counterbalance to, like I said, historically, the U.S. and European kind of dominance on the world stage. I think it traces as Russia was, I think the Soviet Union probably at the time was kind of the genesis of it to, come together, bring together some significant countries that could, in a way, offer some counterbalance to the power of the West, right? And these were obviously not your friendly capitalist democracies that we're talking about. China, Russia, India, these are not your bastions of human rights and freedom and so forth. So the concern that, I've heard over the past few years is this, could BRICS get together kind of and cut out the U.S. dollar from the, the global medium of exchange? Could they cut out U.S. futures markets as the kind of the global benchmarks for all these commodities that we're talking about? And the truth of the matter is, all these countries have very different agendas. A lot of them hate each other, actually. It's just maybe they hate the U.S. more than each other. They don't have sophisticated financial systems, even domestically. They're at times political basket cases, financial basket cases. There has been no practical evidence of them actually being able to create, some sort of financial, network that would be able to remove the U.S. dollar from the equation in global trade. So I'm not worried about those aspects. What I am worried about is the accelerating and purposeful withdrawal of U.S. influence from the world. And, I would argue that the U.S. and alongside us, European dominance of international order, since World War II has been a tremendous benefit to humanity as a whole on net, in terms of global trade and global GDP growth has just exploded, in development of emerging market countries and so forth. So without the U.S. kind of being the police guy on the block with the billy club, right, ready to smack somebody for getting out of line, we're going to see a lot more geopolitical mayhem, and we've lost some of our credibility with allies as to be willing to help us out in certain circumstances because our policies are not as clear as they once were. So, Tanner, what do you think?
I agree with all that. I'd say within just speaking specifically on BRICS, the three countries, if there were to be a strong alliance between all those countries, and there's not really one, because, for instance, China and India are sworn enemies. They've, in recent history, in the last 10 years, they've been in shooting battles in the Himalayas, fights over borders, things like that. And the only reason why India and China have not been in nuclear wars because of the mountain range that's kept them apart. It's hard to see those two countries being actual, real friends. I think the alliance is Brazil, China, and Russia, because Brazil is the connecting point between those two countries. Russia exports fertilizer to Brazil. Brazil grows the crops and exports to China. And then you have China and Russia obviously sharing the longest country border in the world. And so they don't want to be enemies because they don't want to have to watch each other's backs. So plus they have the same common enemy with the United States. And so really, I think those in agriculture, those are the three countries that are the strong alliance-ish. So I think, that would be something to watch, but they're not going to be taking over the world. It's not going to happen. They can try to switch to a different currency and try to get away from the dollar. But how many of those countries actually trust each other? Is there any country that can trust China and their currency? Because they've got a long history of manipulating their currency. India is not a liquid market. Their country is not, they're 1.4 billion people and they don't even have the economy. They're not even bigger than Germany in terms of GDP. So they just don't have the liquidity. Then Russia is a basket case. So there's no chance, even with that strong alliance going forward, if it were to strengthen, there's just no chance for them to dump the dollar. They just don't have it, the liquidity or the trust. So I think de-dollarization is an overblown theory. They're going to try to get away from the dollar. One of the reasons why gold is record high is because China is stockpiling gold as a reserve instead of dollars. But again, good luck with that.
Yeah, I mean, you'll see at the margin the share of reserve currencies and that reserve assets that countries hold will be, as a percent, the dollar will become less important over time, but it will still remain the currency of exchange in the world, really, because there's no other option, right? The yuan, that's not going to work. The euro is only reasonable alternative, and it's just a fraction of global trade relative to the dollar. So, fingers crossed things don't get too out of hand. I'm not terribly worried about the U.S. dollar.
Because we hear, you guys touched on a lot of this, but we hear about, the BRICS has been a phenomenon for quite some time. It's been evolving and expanding and not getting more effective or impactful along the way necessarily. Perhaps there's a negative correlation between the bigger it gets and the less of a threat it proposes, because it becomes more and more of an unwieldy club. But, you talked about the weaponization of the dollar through economic sanctions that we've levied on a number of nations. You think about, the SWIFT international payment exchange system and how we've locked Russia out of that, and after the invasion of Ukraine, and that's another creative evolution in how we, to use that term, weaponize the dollar or exert leverage by being the world's reserve currency. I know there have been within BRICS attempts to, and maybe even some nominal commodity contracts that were traded in non-USD denominated currency, right? So there's been some experimentation at the margins around what would it look like to actually exchange goods outside of the USD complex. But what I'm hearing you guys saying is that that's probably still, all that being said, for all that smoke, it's probably still not the prevailing risk we need to worry about. Another thing I just sometimes think about, though, is, again, in the context of us changing our relationships with our trading partners, particularly trading partners that have been large export destinations for agricultural production in the U.S. As we're doing that, simultaneously, there has been a pretty steady drumbeat of improved land put into production, efficiency of production and yield, and investments in infrastructure, largely supporting, the Brazilian market for corn, and to a much higher extent, soybeans. Do our decisions we're taking now, tariffs, sanctions, blowing up trade agreements, etc., does that accelerate our historical consumption markets for ag production? Does that accelerate their look to diversify and actually start buying more from Brazil and Latin America, buying more elsewhere in the world? And to kind of bring this all the way back, we talked at the top, Rob, about how we might have more of a supply problem that shows up as demand issues. We try to create demand to sort of supply, but are we encouraging the market to look elsewhere for grain? And if we are, that might be the more pressing threat to our industry.
Well, Rob is signaling at me here. I think there's going to be definitely some stress there because, this is something we're writing about right now in our newsletter Gleanings, that when you lose a big market like China, you're losing efficiency, right? So, for instance, let's take this from a theoretical argument to something practical. Imagine at harvest, you've got an elevator nearby, and you've got your big semi-truck, you fill it full of corn and haul it to the elevator, dump and come back, dump and come back. It's big, it's fast, and it's efficient. Everybody knows what they're doing, right? Then the farmer says, you know what? I don't like being beholden to one entity. I want to diversify. I want to get away from whoever it is, this grain elevator or ethanol plant or whoever it is, that one destination that's so easy to ship back and forth. Well, what are the alternatives? Maybe instead of using that one big truck, now you're going to have to shrink the truck to get into some smaller markets. And so instead of using the big semi-truck, now you got to use a bobtail. And now you got to use not one, but 5 or 10. Right? And now you're shipping your grain, not to the one elevator, but to the ethanol plant, to the hog farm, to the feedlot. This way, all these different markets with smaller trucks. Is that going to be more efficient and lower cost? No, it's going to be less efficient. It's going to be higher cost. And you try to get away from that one destination that is efficient, right? We see this with a lot of our customers. They'll fill a unit train and send it back and forth, like in Garden City, Kansas, southwest Kansas, where I'm from. They load 100 cars in Garden City and ship it to Wichita, unload it, or where it gets milled, and then they ship it back, right? That's ultimate efficiency. It's big, it's fast, everybody knows what they're doing. Well, if you're going to try to diversify away from that efficiency, it is by definition going to be less efficient. So, long story long here, sorry, Joe. What I'm getting back to is when we lose a gigantic market, we've got to send grain around the world in a less efficient manner. The grain will find a way. It's just going to be more cost. And what that means is ultimately a lower price probably paid to the farmer, because of a supply push environment, the basis is going to widen out. Now that may work. This is all moot point. If we're supply short, then it's going to be demand pull environment and basis is going to tighten up. But to Rob's point earlier, there's a lot of grain. We're going to be having more grain as Brazil expands production. That's not the situation right now. We're a little tight globally on corn and wheat. But longer term view here, demand is going to slow down. Production capacity continues to grow, especially with Brazil. And that means if politically we lose a market with China, then that means we got to send our grain into smaller export markets that are less efficient.
I think a big piece, one thing I wanted to add to that, it's a great analogy, the Garden City to Wichita shuttle, if you will.
It's very efficient, very fast, very low cost.
But the thing that we have to remember too is that that's not only based on efficiency, it's also based on trust and reliability. And I think that's if you knew that they could load it, but were unsure that they would, it changes that relationship pretty dramatically. And I think that's one of the residual things that I'm worried about with the state that we're in right now is what do we do? What's the long tail risk to the relationships and the trust? And clearly trust is a two-way street. We need to trust our demand markets and our trading partners as well. But I think we need to make sure that it's a multifactorial analysis of what makes for an effective relationship.
100%. Yeah, that's right. Supply chains exist only on trust.
Yeah, I think there was a quote Warren Buffett had many years ago. It takes 20 years to develop trust with a customer. 5 minutes, you can lose it. So
That's right. Well, so I think there's actually a lot of green shoots here for optimism. So we talked about, it's almost like a hard factory reset on free trade. But, when you reboot the computer, some version of it likely does come back, to use you guys' earlier point, where we're shaking it, we're disrupting it, we're challenging the legacy infrastructure of free trade, and we may ultimately arrive back in multilateral agreements in some version reflecting something that we're doing today. We need to pay attention to the supply and demand picture, potentially plateauing or declining demand over time, concurrent with increasing production. So that's going to be a structural challenge for our industry. But then when it comes to BRICS, de-dollarization, shifting appetite for commodity products to non-U.S. sources, those are all manageable risks, is what I'm hearing. And some of them those threats may be inflated. Looking beyond the commodity cycle that we're in right now, looking beyond the near-term chop and turbulence we're experiencing, what would you advise the agribusiness operators and owners that are listening today? What would you advise them to be focusing on to put themselves in the best position to, capture opportunities when things invariably do turn? Folks are under a lot of stress right now, but nothing is static forever. And so, how are you advising clients? What are the messages you would send? What do we want to leave people with here today?
Well, I'll start off with my thoughts. I would say we need to be flexible. Don't tie yourself into any one future for you. If your business was based off of exporting bulk grain to China, right, and that was your only egg in your basket, you're under a little bit of stress now. So we don't know. Nobody knows what this future is going to hold in terms of geopolitics, free trade, biofuel policy, and so forth. So try to remain, don't paint yourself into a corner, right? If international trade struggles, you got something else going on, maybe biofuels. I think my other advice is keep an eye on the biofuel segment. I think within a few years, people realize that's the logical solution. Like we talked about at the beginning, we're short, the country's short on energy, geopolitical, difficult environment. It's nice to have more energy independence. It's a way to support farms. It's good for the climate, right? The big oil refiners are vested in it and own refining facilities, so they are in the camp too. So I think biofuels is going to be part of the solution moving forward. And then people, right? People that work for your company, that have skills and are attractive to the market and can bring value to your transactions, can bring in relationships. It's always, farming, like every business, it's a people business. Like, of course, you would go 10 miles out of the way to ship to the co-op that you like the people rather than the co-op that's giving you a 2 cent a bushel premium. So it's focus in on keeping those good employees that tighten the relationships between your suppliers and your customers, right? That's what I would say. Tanner?
I would agree. There's going to be more premium for management and relationships. As supply chain uncertainty increases, the people that succeed in this environment are the ones that have really good supply chain relationships. Because if you're in good communication with your whole supply chain, you're going to see opportunities that other people don't see. Because you're talking with those people like, hey, this is what's going on in my supply chain, and you see it first. And so you're going to be the first one to capitalize on those opportunities in whatever type of market environment we're in. We're in a lot of change right now. So those people who have that visibility of the supply chain are the first ones that can act on it. So it comes down to exactly what Rob said, quality of people and quality of relationships.
Yeah, I like that. So it's, to summarize here, remain open-minded and don't be limited by your imagination and where the opportunities might be for your business. You need to be rooted in your past, but perhaps not anchored to it at all times, and think creatively about where the opportunities are. Don't write off a market segment that might be less attractive today, biofuels being one of the examples, because in the not too distant future, it could be very attractive again. As always, people, but people in pursuit of specific purposes, right? Helping to create value and bring value to transactions, to help plug you into the supply chain, to help you think creatively, kind of back to the first one around where are the opportunities. And so I think that's great advice. Rob and Tanner, I wanted to thank you both for coming on the show today. Tanner, for coming back for a second bite at the apple. It's good to have you on again. You guys put out a weekly newsletter, the KED Gleanings, which is required reading for myself. So thank you for doing that for the industry, and we'll put information in the show notes to help get the word out there on that, because I think that's a big value to your customers, CoBank's customers. Thanks for taking the time today.
Thank you, Joe. Appreciate it.
Glad to be back. Thanks for having us, Joe.
You bet. And to our listeners, thank you for tuning in to today's episode. If this was of interest and value to you, and I'm sure that it was, I would ask you to do one thing, and that's think about who else could benefit from the content and the nature of the conversation today, and go ahead and share it with them. It's the best way you can support the show, and the best way you can make sure that we're meeting our mission of elevating thinking around strategy execution in agribusiness. Thanks for joining us, and I look forward to having you here with us again next time on the Pacesetter Pod.
This is thepodcastfactory.com.